their revenue was up 3% year on year. How they do that in a low inflationary environment, meaning they actually had growth. And you have to consider Q3 ended at the end of September. That was 6 weeks ago. That was in the worst of the worst when they were still shutting down city by city, and they had a really pessimistic, gloomy view, and Xi was acting tough into the China National Congress. It was just a horrible environment to do business, and yet they grew in real terms. But not only that, this has been a really positive thing. It's kind of like Cooper Standard, the auto supplier. The pandemic forced them to get lean and take a lot of costs out of the business. So when the operating leverage kicks in and things normalize, those costs are going to remain low, and all of those incremental dollars are going to go right to the bottom line. And we're starting to see that with Alibaba, because while their revenues were up only 3%, their adjusted EBITDA was up 29% year on year. And if you remember, last year this time was a better operating environment than this year because of just the timing of their COVID. If you remember, they were first in, first out, et cetera, et cetera, et cetera. So really nice to see they've taken out all these costs. They also repurchased about $18 billion of shares from their $25 billion buyback authorization. I did the math. It's an average price of about $86.14 per share. That is such great news to have a partner like that in the market, because basically what they did was they increased my percentage ownership of the company without me having to pull another dollar out of my pocket. Although we did increase 10% at $61, as we said last year, but 10% of our position size, not 10% of our equity capital. It was 2% of our equity capital at 61. But the other thing they did was they authorized another $18 billion. So they've got $7 billion left on the old one, $18 billion left. $15 billion on the new one. So there's going to be a $22 billion bid in the market. I think they've used about $3 billion. So call it $20 billion bid in the market moving forward, reducing the share count, which increases our percentage, my and my client's percentage ownership of the company without putting another dollar into the stock. Very Buffett-esque. And very positive things. So his thing, we delivered solid results despite ongoing macro environment challenges, which is testament to our resilient business model and our unmatched consumer value proposition, said Daniel Zhang, chairman and CEO of Alibaba. I want to highlight a couple things. So revenues are up 3%. Operating income was $3.5 billion, an increase of 68% year over year. So they got things in order in the most challenging environment that they'll probably ever face in the history of the company. They increased operating income 68% year over year, increase in adjusted EBITDA, decrease in share-based compensation expense. That's very important. They're getting that under control because it's one thing to buy back stock, but if you're just giving out shares willy-nilly, you've got a problem. I hope they go more to cash comp and less to stock-based comp and stop giving up the equity. That'll be good because then those buybacks will be highly accretive. Net cash provided by operating activities increased 31% year on year. Free cash flow was up 61% year on year. This is key. Free cash flow up 61% year on year with only 3% increase in sales. Wait till the sales start to kick in now that Xi has pivoted, and he's only pivoted in the last 2 weeks. This data is from 6 weeks ago when things were horrible, and actually 6 plus 12, going back 18 weeks ago or 4 months ago. And for those of you who've been following the stock, the environment was horrible over the summer with all the government nonsense and everything else leading into the China National Congress. So they go into Tmall. Tmall is in Chinese minds. It's the place to go to shop, et cetera, et cetera. They were down a little bit on that, on consumption. Demand was slower over the summer because of the things that we've covered. This Cainiao logistics business is really interesting because it makes up a part of Other, but Other is becoming more and more important in the business. They grew 26% year on year. 73% grew from external customers, package delivery from external customers. The cloud was up 4%, which was good. Non-internet industries, if you remember, they took a big hit from their largest customer, was one of the online education companies, and that really hurt them in the last couple of quarters. If you remember, that was from last summer, I believe. And but their non-internet is growing 28% year over year and contributing 58% of cloud revenue. Strong revenue of the non-internet industries was driven by financial services, telecommunication, public service industries. Revenue from customers in the internet industry declined 18% year over year, but that was, again, mainly driven by declining revenue from the top internet customer. That was an online education provider. If you remember, that industry basically got shut down. They gradually stopped using our overseas cloud services for international business, etc. So Alibaba Cloud continues to develop, expand support, and our partners to better serve our enterprise customers. Okay, so they go into this data centers and hardware, serverless ecosystem, etc., etc. And by the way, their loss was attributable to public market securities. So the Chinese equities that they owned over the summer, which went down, is what really hurt them more than anything. So that's more of a mark-to-market issue. The most important thing in this press release, as far as I'm concerned, is free cash flow up 61% year on year. Unbelievable how they pulled that off in this environment. Really exciting to see. And as we get through here, we can look at the divisions. So total China commerce was down 1% year on year, which is not bad considering, the country was on and off lockdown all summer. People didn't know if they were going to have jobs. Their businesses were shut down every other day. Not a great situation. And they were still able to pull this off. That's good to see. International commerce was up 4% year on year. Wholesale was up 6%. Retail was up 3%. That logistics business that I talked about, which is a 7% of revenues, it was up 36%. That's huge. Local consumer services up 21%. Cloud up 4%, which is now 10% of the company, the cloud business. That's only going to grow more and more, both domestic and internationally. Digital media, that's only 4% of revenues, was up 4%, etc. So the total top line was up 3%. Free cash flow up 61%. Very exciting. The stock was up 7-8% today last time I looked. In a down market, by the way, which is good to see. And in a market with a strong dollar today, because Bullard, who's going to lose his voting rights after January, so he's completely irrelevant, comes out and says we could take the Fed funds rate up to 7%. I mean, it's unbelievable. This guy's completely lost his way. 2-3 years ago, he was the most reliable, substantive member of the FOMC, and now he's just turned into, something completely different. But he's on his way out, probably interviewing for private equity and hedge fund jobs as we speak. And that's that. Maybe the firm he's going to has a short bet on treasuries, as like every macro firm is crowded into short treasuries. And, that I think that trade's going to unwind very, very abruptly before anyone can get out. It's going to be a very crowded exit on the short treasury trade. But nonetheless, that's that. Basically on the cloud, he said, in our cloud segment, Alibaba's cloud revenue was 4% year on year this quarter. Through structural adjustments over the past few quarters, Alibaba cloud revenue is now healthier and more sustainable, meaning, they're not going to lose like one customer that accounts for the majority of their business, which they had to deal with the education company. Public cloud revenue grew double-digit year on year, while hybrid cloud declined. That's related to that. In the interest of pursuing higher quality growth, we proactively controlled the development of our business that only resells homes. Okay, looking at our revenue by non-internet industry grew 28% year on year. Its contribution to total revenue increased from 53 to 58% quarter on quarter. Fastest growing sectors include financial services, automotive, telecom, and public services. In this environment full of uncertainty, our wide-ranging efforts in cost reduction and efficiency improvement measures are beginning to bear fruit. No kidding. Businesses such as Taobao Deal, etc., Lazada, Youku have significantly reduced their losses. We will continue to focus on steady improvement of business quality and on investing in building capability to provide customers core value rather than pursuing short-term business growth or user scale. As China enters an era of high-quality development, we will also enter a stage of high-quality business operations. During During the 8 years, this is critical. Listen to this. During the 8 years from Alibaba's IPO in 2014, the quality and scale of our business has improved significantly. Alibaba's revenue today is 12 times what it was during the same period in 2014. 12 times. By the way, you can buy it at 2014 prices. The revenue's up 12 times. Adjusted EBITDA is 4.5 times, 450% what it was during the same period in 2014. You can buy it at 2014 prices. And free cash flow is 4 times what it was in 2014, and you can buy it for the same price. So over the past 8 years, China GDP has almost doubled. We are confident about the future and will continue to execute our share repurchase program, i.e., if you're not going to buy our stock, we will. And as China enters an era of high-quality development, we'll also enter a stage of high-quality business operations. They covered the buyback. We remain confident about ourselves and even more about the future, no matter the ups and downs. We believe in the prospects of China's economic and social development. We believe Alibaba's development goals are highly aligned with China's long-term goals. We believe Alibaba can play an important role in the digitization process in China and around the world. We have taken note of the latest adjustments to China COVID-related policies and the proactive commentary from relevant government regulators about promoting the digital economy and high-quality development of our platform business. This is critical because this was a shift in policy from the Chinese government, but more importantly is the McKinsey report about the cloud tripling by 2025 and Alibaba having 37% of that cloud business. So if you extrapolate that out, assuming they don't gain share, which I think they will, you're talking about a $30 billion business, close to $30 billion margin on that, as you see with Alibaba, with Amazon Web Services once they hit scale. That's an extra $10 billion of operating income, which is 60% more than their peak when they hit $319 a stock. But so this is key. The government is now, what was a government headwind is now a government tailwind. The government needs this high quality development, and Alibaba is the biggest player in town. We believe that COVID will ultimately pass, that our society, our economy, and our lives will eventually return to normal, and the massive potential of China as the world's second largest economy will be further unleashed. Last but not least, we believe in the platform economy that Alibaba is part of can make unique and valuable contributions towards serving small and medium businesses, creating employment, and pursuit of better lives. So they're basically laying out what we already knew, that in order for the government to achieve their long-term goals, Alibaba is going to have to play a major role in that moving forward.